Okay, everybody should be here. Hello, everybody. Welcome back. Hopefully everyone enjoyed their Easter break and the last couple of weeks, and everyone had some good trades. There were some good ones out there. Tonight, we're going to be covering advanced strategy sessions, how to scalp the 15-minute time frame. My name's Thomas Atkinson, as always, joined by Tyron Abella.
Hi everyone, and welcome to tonight's webinar. 15 minutes is one of the best time frames for scalping, especially for the people who are low on time and they need to dedicate a 2 or 3 hour period. So really looking forward to getting into tonight and working out some of the best strategies that you can use.
So just before we get started with the risk warning, I'd like to just let everybody know tonight will be a little bit of advanced strategy. So we are going to be in the charts a little bit more, and we may be skipping over some of the indicators and some of the things that we are using. If you have any questions about those particular indicators, you can always check out Pepperstone's YouTube channel, and a lot of our older webinars have been uploaded there. And we explain many of the indicators that we're using tonight, many of the patterns that we're using tonight in those webinars. Okay, so to get started, obviously the risk warning, the information provided in the videos and webinar tonight has been produced by a third party and does not reflect the opinion of Pepperstone, and the information has been provided without any alteration or verification. It's also important to understand that everything that is said tonight is obviously general advice only. Okay, so what are we going to be covering in today's webinar? We're going to be taking a look at where to place stops based on price action, and that's very important with a lot of scalpers out there. If you're scalping, often it's very frustrating to get stopped out and then see the trade go in your direction. So we'll be having a look at where to place stops, how to do it, a little bit of information on how to place a little bit extra room so you don't get stopped out to the pit. Live market analysis and some examples what to look out for. So we'll be having a look at a couple of breaks that have happened over the last week and what we're looking out for and what you generally want to be doing. Then we'll be taking a look at how to set up take profit targets based on pattern analysis if we see it on the smaller time frames, and then talking a little bit about supply and demand zones. So really supply and demand zones are mostly talking about really support resistance and where we think the market could go and then get picked up maybe by buyers or sellers. And then to finish off, we're going to have a look at 5 key advanced trading tips that we believe that all you guys need to know and also need to be aware of whenever you are placing, especially scalping style trades. Okay, so before we get any further through these slides, let's actually take a look at the market and where we are sitting right now. Now, I want to bring up the Australian dollar straight away. Many of the guys out there tonight will be from Australia because Pepperstone is based here and obviously the UK as well and other countries, but they started in Australia and that's where we're from. So here we've got the Australian US dollar daily. Now, I know we're talking about 15 minutes tonight, but it's always good to have a bias on what you think is going to happen on the direction. And Tyron, do you want to talk us a little bit through bias and why that's important?
Sure. So with bias on the longer time frames, straight away it gives us a bit of an advantage when we go back to the smaller time frames because we don't really have to work on the direction too much because we've already got a bias of where the market is strong. Now, it's okay to counter trend and basically play every angle you want on the smaller time frames, but you must remember that the moves are always going to be stronger and with a little bit more momentum when they are in the direction of a bigger trend. So we always like to look at the bigger time frames, even if we are moving down to a 15-minute chart, just to give us a bias on where the strength really is. So we can have a look here. We've marked out this descending triangle on the Aussie USD on a daily chart. So this is a very significant pattern, purely because obviously it's on a daily chart, and we've got our moving average crossover there, which is important. It happened just before the break of the strong support that was around the 70-cent level, and now we've had our break. So what this has given us is a really, really good opportunity to delve down into the smaller time frames, the 15-minute one in particular tonight, and just look for basically shorting opportunities because we don't really want to be longing in the direction of or against the direction of the prevailing trend, even on the smaller time frames, because the entries just have to be so much more pinpoint to actually get the best out of the move. Whereas when you're going in the direction of the prevailing trend, even if you're a little bit off on your entry point, you'll still generally get carried with the momentum and your trade should reach its potential. So really, really important just to know what the prevailing trend is doing.
Remember the saying, trend is your friend. Trend is your friend in all time frames. If you're trading the 15-minute, daily, 4-hour, weekly, following the trend is always going to be better for you longer term, because that usually holds up for quite a long period of time. Like we can see on this Australian, for a long time, it's really been in a bit of a seller's market, and then it's now broken through this very strong support level here. So let's dive down to the smaller time frames, which is what we're all about tonight, and start having a look. Let's just jump straight into the 15-minute and load that chart up, and then talk about what's happened recently and what has been happening. So here's the 15-minute. What we'll see is this line here was our support that was broken, and since then the 15-minute's mostly been selling off pretty consistently. So Tyron, do you want to walk through one of the things that has happened here with the moving average and some of the things that we look for as I guess scalpers and traders?
Yeah, certainly. So when we go down to the smaller timeframes, we are looking for those little tips that the indicators can give us. We don't always use indicators just as the number one rule, but we certainly employ them once we know what we're trying to trade. Now, one of the most basic moving averages that we like to look at, when I say basic, one of the most important that we always look at, it's almost imperative to have on your chart, is the 20. Okay, now we're going to circle all of the touches that the 15-minute did on the 20 moving average here. And just to really highlight how many opportunities this actually gave you, even if you were employing something as simple as just a pullback to the 20 moving average in a strong trend, how many opportunities you actually have had to join this prevailing trend down. So you can see them here circled in the yellow. Every time it's touched, basically it's done the business. Now, what's also quite important on a couple of these circles, and we'll also highlight those, we've also had a candle confirmation at that moving average. So we can see here that we've got a shooting star, we've got another shooting star there. These are really, really important candles because they're basically, even though they're only on a 15-minute chart, they're still giving us that price action for that 15-minute period at a critical point, which is the 20 moving average. Okay, so when we highlight those, it looks very, very clear when you can actually highlight them and circle them and see what the market has actually done. But this happens time and time again in all markets. This is just today's example because this is what the Aussie has been doing for the last couple of days. So we can see very clearly, that's a great example there that we've highlighted and made a little bit bigger for you. That shooting star, right at the point of the touching of the 20 moving average, then down she came. You can see the aggressive move down, like you're talking about 20 to 30 pip move on a 15-minute chart, which is quite good. You've got to be really mindful when you are scalping that your targets are basically relative to the time frame that you're looking at. So a 30 to 50 pip move on a 15-minute chart is a pretty significant move, and one that we would certainly be happy with as scalpers.
So one thing you want to do when we'll step back just a quick step here. So we've obviously analyzed that the Australian dollar is broken past that support and is looking more to the short side. So what we've even just seen recently, and it's actually on its way right now live in the markets, is that we saw another touch of the 20, and then we saw that really nice rejection happening here, and then since then some pretty strong short off candles with it really testing that support now. This is the kind of scalping that you want to do when you see multiple reasons to be in a trade, and it's all about having as many reasons as possible to be in a trade. Then generally scalping goes quite successfully for you. So it's not just about saying, okay, it's hit the 20 moving average. Well, it happens all the time. It's more about saying, okay, we've seen a strong support break on the larger time frame. We've come down to the smaller time frame. We've seen the 20 being tested and respected multiple times. When we then see maybe a candle confirmation as well, or we see overbought on the stochastic, or we see maybe a MACD switch or something like that happening at the same time everything else is happening, then that adds strength to our scalping technique. So it's about having as many reasons as possible, and that's something we preach over and over and over again.
Yeah, and one of the most important things that we really need to acknowledge in this particular trade, I mean, it's falling away as we speak, is that the most important indicator of them all is price. Now, we always have to be very, very mindful of that. And when the smaller time frame is making a series of lower highs and lower lows, that's probably the most important thing that you can take out of. That's the first thing that you look at. You know the price is making new lower highs and lower lows, so you know price action is certainly trending in the direction that you want to go. So really, it comes down to just finding those reasons, finding the mini support and resistance levels that are being tested on the way down and retested once they break through. You can see here we've all drawn a little mini support that turned into resistance basically at that candle. You're going to get these all the way down, and yeah, quite frankly, if price makes a new lower low here, which it looks like it's all but trying to do, we could probably expect that this trend will more than likely continue for a little bit yet.
So let's unpack again this Australian dollar. We had that support. The support was broken, was then retested at the same time it was testing that 20 moving average. At the same time, we had the overbought on the stochastic, and then we had that shooting star candle as well. So when you are putting all those things together, we've got many reasons to be in. So we like to create point-based systems based around as many reasons as possible. Many people do a different way. I like the idea of building a system where maybe you need 100 points to be involved, and we'll talk through that later on one of the slides. But we've got that support, it's been broken, retested, shooting star candle. Now, where do a lot of you guys out there tonight think the stop loss would want to be if you did take this trade? So let's say we were involved in this trade and we got in after this candle closed. Where do you think the stop loss may need to be? If anyone out there wants to answer just quickly, we'll see if you guys know. Okay, so someone has, yep, a few people have put in some good examples there of where they think it should be. So, which is good. So a few people have said above the previous highs. So one thing you can do is you could always take the distance of this particular candle and then place it a little bit behind by a percentage. So in this case, it's quite a small candle. What you can do is you can get distance, which is only 3 pips, and then you might say, okay, well, I need at least another 2 or 3 pips behind that. Another thing that you can do as well is you can say, okay, where was the last swing? So the last swing was up here, and then of course it swung here before it broke through. So this is a very conservative kind of stop loss for your scalp behind this particular swing here. And then you can work out, well, what does this trade make sense to us? So if we got in here, what would our stop loss need to be? What would our potential take profit need to be? As we're in a fairly aggressive kind of shorting period here, do we think that the market will be able to go this distance again? And what you'll generally find is that, especially with the tight stop loss, that if you just take it down to the previous lows, you'll often get even 2-to-1 style trades. And that's the real type of scalp. Ideally, Tyrone and I would like to see a little bit more pullback. We'll talk about the pound yen soon and the opportunities that presented. But these are the types of things that you want to be thinking about when you're placing a trade. It's not just about being able to say, okay, I'm going to get in. All these things are saying yes, tick, 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 tick. It's also about where is my stop loss and where does it need to be for me to have the greatest success and chance of getting that take profit that I need. Got a quick question in here about the moving averages we're using, 20, 50, and 200.
Yeah, so I've just added in the window for all the people who are looking. Yeah, you can just go check your chat window. We always use the same moving averages because we know we identify them immediately, obviously, by knowing their color, but these are the ones that we find work the best. Now, just in regard to the stop loss that we're talking about, adding a few people have mentioned that it should be above the star candle and also the moving average, the 50. Look, the more obstacles that you can put between your entry point and the stop loss level, the better your trade is going to be, or the safer, if you like, it's going to be, because there's more things that it has to break to actually go out and stop you out. Now, we can see that the 20's been a bit of a fortress for it. So the red line here has been a bit of a fortress to hold it back. Hasn't really touched the 50 since, well, it's been quite a few hours now. So yeah, this trend is starting to get aggressive. But for all you people who actually said going behind the 50 moving average, if the distance allows for it. So, and by that I mean, if your stop loss doesn't have to be extra big just to make it, to make sure that your take profit is in line with what your risk is, absolutely try to put it behind it, because it does make a difference. Yeah, the 50, if the 20 doesn't hold it back, there's a good chance the 50 will, before it actually continues on its downtrend.
Okay, we'll revisit the Aussie in a few minutes, and we'll just see how this plays out over, I guess, the distance of this webinar, because it's 15-minute. See if it breaks a new low, how aggressive it is after that. That'd be quite interesting to see. Jump over to this pound yen quickly, and then we'll just have a quick talk about the same style and concept. So here again, we've got the daily. Tyron and I really love the daily to get started. You'll notice that I have a very strong support drawn across this level here. And again, we have that descending kind of triangle that has been broken last week and then it's continued on. So when you see a break like this occur, and you see that very strong support break happen on the bigger time frame, it's a great opportunity to then jump into the smaller time frames, such as the 15-minute, and start to look for trading opportunities. And we'll see straight away it was very, very aggressive off the break. So let's just actually draw up. We've got the line in there, so we'll go to the 15-minute. We'll zoom that out, and we'll see how aggressive this pattern's been. So quite aggressive. That 20, especially held at the start. Then it kind of had that little double bottom here, and it went and it started consolidating. Then the next break happened where it broke through that support again. Very, very aggressive. And then, of course, it's come back up. So there's a lot of different opportunities that have happened in terms of scalping on this pair. Tyron, do you want to talk through this one over here? I think a lot of people will get some insight from this particular pattern that we're seeing here as well.
Sure. So we are referring to this double top in basically the direction of the prevailing trend. So any of you guys who do our regular webinars would know that we're big believers of following patterns in the direction of the trend, especially for that continuation. We can see that this one played out quite nicely. Hopefully everybody can see the two peaks on this double top, the neckline break, the MACD divergence that we've just put on the chart. That this is Class B divergence, which is amongst our favorites on the pattern trades. We've got a confirmation moving average crossover just prior to the break, or just happening just as the neckline broke, and it pretty much hit the target. Well, within three or four candles, really. Like, it happened very, very quickly. So like it often does on a 15-minute chart. And look, that's the beauty of scalping. Of course, you can get the instant reward fairly quickly. But I guess probably the most important thing that we can take out of this trade setup is that look at all of the things that are telling us that this is more than likely going to go short. For starters, we've got the trend going down. That's always a big thing. We know the prevailing trend is in our favor. We've got a double top in that direction. We've got a moving average crossover at around the place where the neckline's going to break. We've got the all-important MACD Class B divergence on our side. There's a lot going for this short. And and when you're scalping, I mean, it's hit its target fairly quickly. So although it has continued, we can only ever really, shoot for what we're looking for in regards to the pattern that we're trading. So hopefully everybody can see that. And that is just an absolutely, beautiful scalping trade. Now, a lot of people think that because you're scalping, you're not going to see patterns. You're not going to get the confirmation that you'll get in otherwise, larger time frames. But I think this is a really good example on a 15-minute chart of how quickly it can happen. And this set up, in a matter of probably, a day and a half. It's not like it took, days and days to set up. So, very, very important. And this does happen a lot. This is just the most recent. We're trying to isolate trades tonight that are happening in the here and the now. So it's really, really important to pay attention to this. Even if we go down to the most recent price action on this one, we can see the moving average tried to cross up, couldn't quite do it, but that started a series of lower highs and lower lows. And once the new lower low was broken, you can see what happened. It basically shorted, that extra 15, 20 pips that we're looking for straight. Basically broke that level again, a mini support level, and off we go.
Yeah, when these things happen and you've already got that prevailing trend, just like we had here over on the left-hand side. Oh, we'll just stop that. We'll bring this over. Look, when we draw this support through here, and then what happens after that support's broken. It can often be incredibly aggressive because we've identified a daily trend break. The 15-minute, when it breaks these consolidation periods, which often happen through the Asian area, if this happens into, let's say, a London Open or a New York Open or something like that, it can be a very aggressive, very sharp, very fast move. So when that break happens, it also gives you a very great opportunity to potentially get into the trade, place your stop loss above the last swing, which many people correctly identified. It's all about recognizing the swing areas when you're placing stop losses using the price action, and then shorting that down for a certain period. Usually what you want to do is look through the previous history and find where you think it might be able to go. So using previous history, using price action breaks, and using price action as the stop losses are very, very solid techniques for your scalping system. And even if you're using a whole bunch of different indicators, price action still generally is one of the best places to place your stop losses and take profits. Think of price action as the psychology of the market. Okay, quite a few questions coming in. We'll try to get to answer some of those tonight as much as we can.
I'm answering some of them on the go, but I will bring up, if any of them are relevant to the actual chart that we're looking at, we'll actually bring them up and talk about them to the room as well. So it's really important. So keep them firing, guys, because it's all about you. So yeah, anything you really want to know about what you're seeing, just certainly fire the questions off, and we'll do our best to answer them in real time so we can actually show you on the screen.
So let's just jump straight back into the PowerPoint slides. Obviously, we want to, firstly, before we even start scalping anything, recognize those market conditions. So one thing to write down, recognize the market conditions. Are we in a channeling range-bound market, or are we in what many of the pairs are now, which is a trending market through some fairly large breaks? So that's something that's very interesting and very important to understand. Now, Tyron and I wanted to run through MACD tonight, and we wanted to do this because we feel that it's often underutilized or wrongly utilized. So one thing that people can do is you can use moving averages to help you with, or MACD to help you with moving average touches as well. So Ty, do you want to go through MACD as well and let everyone know how another way of potentially using it?
Sure. So look, what I'll quickly touch on MACD is what a lot of people don't know is that the MACD, which stands for moving average convergence divergence, is basically the histogram is really representing the distance between the two moving averages that the MACD is representing. So in this instance, and on what most platforms are set to as a default, the 12 EMA and the 26 EMA. Okay, so we can see those two lines on the chart here. We've got the blue 26 and the 12 EMA. What that histogram is representing is the distance between those two moving averages. So as the histogram crosses from above zero to below the zero line, you can see that's exactly when the moving averages cross from the slower to the faster moving averages up and down. Now, as the moving averages move further and further apart, so we can see here when the histogram is growing down on the negative side, it's getting bigger and bigger. The faster moving average is accelerating away from the slower moving average at a more rapid rate, which is telling us that the momentum in the market is basically accelerating and increasing. Okay. Then when the histogram starts to slow down, the moving averages are getting closer and closer together, which is telling us that the price action is starting to slow down and lose some of its momentum. Now, that's why divergence is so important, because what divergence is telling us, especially when it's a class B or a class A, is that the moving averages are not confirming what price is actually doing. So price may well make a lower low or a higher high, but if it's not confirmed by the moving averages, it means that the momentum has actually shifted. And although the price has made a new high or a new low, it's not backed up by the momentum of the market. So that's what we're looking for. We're looking for an opportunity to exploit that divergence and trade in the opposite direction.
So here's just a way of calculating MACD, but many of you guys will know that already. One of the things we don't mind following when it comes to scalping is to potentially look at maybe going long when the MACD line crosses from below to above the signal line, and then going short when the MACD line crosses from above to below the signal line. So that's something that a lot of people do follow when the moving average when I guess you've identified trend and you've also figured out potentially it hitting one of the moving averages, and it maybe even shows something like one of those shooting stars or hammer candles. So here's just an example of what we're talking about. Ty, do you want to go through that again?
Yeah, definitely. So as we can see here, every one of these letters is representing when the moving average, which is the red line, that is a 9 moving average of the histogram of the 2 moving averages. So it's basically a smoothed out average of the other 2 moving averages. You can often find that when the signal line re-enters the histogram or exits the histogram, it does provide a trading opportunity. So what a lot of people like to do, and it's a method that, look, a lot of beginning traders use it. We don't use it personally, but we look at it sometimes because it does actually present some opportunities. I certainly wouldn't trade just off it. But if you're looking for a very, very basic scalping concept, you can see that every time the moving average, when it's above the 0 and the histogram is above the 0, enters the histogram again, it actually does push price up. And a lot of the times you can see every time it's happened here, we can see it at G, we can see it at A, we can see it again at B to a lesser extent, and we can see it at C, that price has had a little bit of a spike. Now, again, this is not something that you would just use in isolation, but it's certainly something to keep in mind because it does represent what the moving averages are doing relative to price.
I think that's the important part. It's not about anything by itself. We're talking about price action. We're talking about MACD, stochastic. Now, I think it's somebody out there has mentioned that there's too many indicators out there and price action is therefore the only way to trade. So I think one thing that we see time and time again with a lot of students and a lot of people that are scalping is their chart is so many indicators, they can barely even see the price. So all they see is just tons and tons and tons of different indicators. What I like to do and what Tyron likes to do is we actually build a story for scalping based on price to start with. So again, we usually identify that daily trend. Then we jump into, once we see a trend forming or something that we're happy with, then we go to our 15-minute time frame, and then we start to get a story together of what we might be looking for. So here, straight away, my eye goes to this, what was double top. I mean, if I was seeing that forming, even if I was here, I would literally be setting alerts for, at this price, a break kind of point, where mobile alert, just in case. And I'd also then be setting an alert for down this level. And I do that because if either of those levels hit, I'd want to come and have a look at the chart and see whether the pattern was forming. It's about being able to recognize that pattern first. Another thing that I'd be doing is I'd be looking at potentially, if the market came back to this peak, what kind of candles might be forming. What if we saw a shooting star candle here? What if we saw another type of pattern happening here, or a big engulfing candle, or any of those types of things? That's something that we're going to want to come back to and then start to form our story. So once we've formed the story, like we have here with the double top, let's say we're here at price. Then what Tyron and I would do is we'd bring on some of our favorite indicators. So we'd bring on our MACD and we'd bring on our stochastic indicator. We like both of these a lot for scalping, and we would be starting to say, okay, well, do we have overbought stochastic when it's coming down? Yes, we did. We had some overbought up here. Then also, do we have any kind of MACD divergence, or do we have any other kind of MACD signals where maybe the histogram is dropping off and the signal line is out? And that is what has happened in this case. And all of those things together give us enough strength to say this is most likely going to be a higher probability type of trade. So is that making sense to everybody, that it's about putting everything together? And we like to start, of course, with the price action first, but you can use anything. I just find that generally when we're helping people, they come to us with 6 or 7 different indicators on their screens to start with, and they're very confused about which ones they want to use. So we like to start with the price action first.
And the problem is too, a lot of the indicators that people do use out there actually contradict other indicators that they're using at the same time. So, yeah, what's really important, and my advice to all of the traders in the room, make sure that you actually understand the indicator that you're using and understand its purpose and what it is trying to tell you. Because a lot of the time, people get caught up in the hype of popular indicators, but they don't really understand exactly what it is that indicator is trying to tell them. And yeah, consequently, you're going to get mixed signals from those indicators because they're really contradicting information. Now, when you use things like Bollinger Bands, you need to know that that's basically a volatility indicator, and it's measuring the volatility in the market. Okay, stochastics is measuring the last 14 periods of high and low periods. The MACD is measuring the distance between the 12 and the 26 EMAs. So when you understand what those indicators are trying to tell you, you have a really good understanding of what the patterns are actually, how they're interacting with price. Are they confirming what price is telling you? And then you can make decisions on what those indicators are telling you, because you know what those, it's not based on what somebody said on YouTube. You know for a fact that if there's MACD divergence, you know that the 12 and the 26 moving average are closer together than they were at the previous peak, even though price has made an equal or higher peak. That's telling us that momentum has left the market. And that's the point, making the indicators work as part of the process of identifying where the price action is going, not just doing it on a whim.
Okay, we'll just quickly skip over to gold. I think gold's presented a little bit of an interesting opportunity as well recently. So again, daily, start with the daily. Let's not have any particular indicators on our chart. So here on the daily, we analyze this double bottom, and that's always good to do. When that double bottom breaks, then we could start to look again on the 15-minute for potentially buying opportunities. So that's what you want to generally do. You find a daily trend, you find a daily break, and then you start to look for 15-minute buying opportunities. Now, sometimes there isn't going to be any. I'm not saying there is or has been one that's been very strong on gold, but that is what you want to be doing. And then you come in here and you basically say, okay, well, do we have any hammer candles? Do we have any double bottoms on the 15-minute time frame? Do we have anything else that's telling us to potentially go long? And if you do see those things, then you can get involved in the trade. So that's usually where we start from. And it's just about repetition and continuously checking different pairs. You've got 20, 30, 40, 50 even pairs easily with the Pepperstone platform. So if you're picking maybe 10 or 15 that you want to scan daily, there's always going to be opportunities on those different pairs. It's not about just saying, okay, I'm only going to trade Euro, US dollar. Because in scalping, the Euro US dollar is not always going to be the best scalping tool.
Yeah, when you are scalping, you are going to need a few instruments in your trading arsenal, because otherwise what you'll do is you'll find yourself trading situations that probably shouldn't be traded, because you're not giving yourself enough, I guess a broadening view of what's happening in the real market. So if you're hell-bent on only trading the Euro USD, you'll find yourself trading the Euro USD whether there's a trading opportunity or not, primarily because it's the only one you're trading. When you are scalping, it is important to cover a few more pairs. That doesn't mean that you have every pair that's available to you, loaded up on your screen. Like, there are literally hundreds that you can trade, but you want to become intimate with a handful. Like, even anywhere between 8 and 12 is probably a good number to aim for, especially if you're first starting out. Because you do really need to understand and try and learn what is normal for that particular pair. That's really, really important when you're scalping, because look, the thing is, when you start getting familiar with, say, we'll use the euro as a bit of an example. When you are familiar with the euro and you trade it a lot, you know that an average move per day is about 60 or 70 pips, perhaps, when the market's moving properly. So anything that's bigger than that is abnormal to what the euro normally does. So if you're going to have a take profit of, say, 70 pips on a euro trade that's not really trending heavily in a market, you're expecting the euro to do its full range of movement from your entry point to your take profit. Is that realistic? Probably not, especially if the market's only going a little bit sideways. So whereas if you're going for a 20 pip take profit, because that's what the trade dictated, you've got a pretty good chance of getting that, because its average range or its average movement per day might be 70 pips. So taking a third of that, or even a half of that, would still be acceptable. You've got a pretty good chance that your take profit's going to get hit, because it's not unusual for that trade to travel that far on a particular day. And that's why it's important to understand your currency pairs, to know what their average is per day, and basically work within those guidelines, because most of the time the market is not trending heavy.
So here we've just got the example of the US dollar again. I think if you looked at the daily here, you'd see that a fairly significant break happened recently, and it's been in a fairly strong sell-off since all that volatility earlier in the week. So I was on the 15-minute. I just wanted to bring this one up because if you look through, look at how this support, it was support, it broke, it came back through, and then started consolidating. This is quite a nice consolidation with a nice little breakout that's happened recently, and that's the type of thing that you do want to be seeing. So you recognize your patterns, recognize the consolidation. When the break happens in the direction of what you believe the trend is, which may be to the short side, then you can start looking for other shorting opportunities. And maybe that's something where the market pulls back and it tests this level again. At this level, it pulls back up here, it tests here, and then you see, let's say, this type of candle at this level. Do we think that might be a decent opportunity? It could potentially be a good opportunity if you see something like that kind of candle occur. Or
I personally would be very excited about that, Thomas.
Yeah, that would be nice, wouldn't it, Ty?
Yeah, and not only that, you've got to also understand that if price does happen to do that, what's going to be at that role reversal area, apart from the previous support, you're also going to have the 200 moving average right in your face. Like, you can just imagine that if it travels any further, the 200 is going to be there to add extra resistance to stop it from going long. Coupled with the fact that if price does move up a little bit more over the next 5 or 6 candles, that 20 and that 50 are going to level out a little bit. So there's a pretty good chance that you're going to have all 3 moving averages right in that area. Now just think about how hard that's going to be for price to actually get back above that, especially when we know we've already got a bias to the weak side. That's why it's really important. And a lot of people, look, one of the biggest questions and the most common questions we get is that people seem to think that technical analysis is always hindsight, and you can't really see patterns work on the smaller time frames. Well, I'm seeing patterns galore on all the things that we've been talking about tonight, and they've been basically happening in the here and the now, and they're pretty easy to spot. So as long as you know what you're looking for, you will see them everywhere, which actually brings up a pretty good point. For anybody who hasn't got our pattern cheat sheet, you can actually, I'll pop an email address into the chat window, send us an email to our support, and we'll send you a free cheat sheet that we've got, where you can basically, all of the patterns that we use are on it, and you can basically, pop it near your screen. So what it does, it really forces you to check for the patterns that you otherwise might miss if you weren't thinking about them. That's the problem with a lot of traders. They get the blinkers on a little bit, especially on the smaller time frames, and they aren't actually looking for patterns or confirmation, because they're just hell-bent on the scalp. But sometimes if you've got a reminder, like a sheet on the wall, you do actually see them unfold, because they are everywhere and they happen in every time frame, no matter how big or small.
Okay, let's just talk about, again, take profits and stop losses. There's a few questions out there for these, and also about how to manage your potential scalps. So one thing is, let's say this was setting up, and let's say you were potentially getting involved in the market at this point here for whatever reason. If that was happening, then you could place your stop, let's say above the shooting star, if that's what happened, and then you would be looking usually for the distance that previously it happened. So let's say the distance was down to this point here, and that's where we might want to say, okay, first take profit. So we take our first take profit at this point, but then we also say, well, what's stopping it from potentially going down to even the lows that it did get to previously? So maybe we want to set a second take profit there. And that's fine. You can do that. You can scale in and out. This is where you start customizing your scalping strategy. You might partially close it. Now, anyone that trades with, hopefully all you guys do trade with Pepperstone. If you trade with MetaTrader 4, you can get the advanced trading tools, and that does allow you to get partially out of trades and manage them a little bit more effectively than the traditional MetaTrader 4 platform does allow. So you get a whole bunch of different things here, and you'll see them on my left-hand side, and some of these tools will help you to start scaling in and out of your trades. And that can be very helpful, because in a scalp, if you're sitting there with a 10 or 15 pip stop loss and you take 50% of the order off at 10 or 15 pips, but you can very feasibly see potentially 100 pips away, there's a very strong support that you think it could get to, and you know statistically that it may get to based on your previous experiences, then you could potentially leave that order on and get a very healthy kind of, I guess, profit target. And that's what you want to be doing with scalping. You sometimes want to recognize the opportunities. You always want to take a little bit off, because that will help your psychology, and you don't want to lose it all, or let yourself get broken even. But by scaling in and out, it can be very, very good. All right, we'll just quickly revisit this Australian dollar. As you can see, it's continued to kind of short off. I think before, when I had a look at it, it looked a little bit more towards the buy side, and now, of course, this candle 15 minutes on is now starting to look more to the sell side. So we'll have a look at that when it does close in 5 minutes and see what's happening there.
Yeah, and what's interesting with this trade as well is that you'll see that the stochastic on the 15-minute has basically reached the oversold zone on the 20, but probably just as importantly, I know we had a couple of questions earlier on about are support and resistance levels important when it comes to taking profits and putting your stop losses. And this is probably a pretty good example, actually, because not only are support and resistance zones important, but also price action points. Like for anybody who's done our normal webinars, you'll know that we highly respect the 20, the 80, and the 00 areas. So you'll see that the Aussie here is struggling to break the 69.20. So it's hovering just below 69.20 at the moment, but it's pulled it up a couple of times. But you can rest assured that yeah, most of the time when it approaches a 20 from above or an 80 from below, it is going to have some difficulty getting through that. It doesn't usually charge through unless it's a news-driven event. So if you were taking, so I guess my point is that if you were taking a take profit target from that shooting star off the 20 moving average, you basically, you know, this would be a very quick scalp because it's only on a 15-minute chart. But one of your first points that you're going to have trouble breaking is that 69.20 zone. So that's why you've really got to assess your risk reward to make sure that there is enough distance between your take profit and your entry point to justify the trade, because you don't want to be going anything under a 1-to-1 trade risk reward ratio because it just makes everything all a little bit too hard.
It's just a quick example of stochastic. We won't go over that too much because, of course, it's more of an advanced night tonight. Just in regards to strategy, here's just a bit of an example, but we like stochastic. We like support resistance, as we've mentioned heaps of times. We like, of course, finding a trending market. We find that be very much more successful with scalping. It's more aggressive than a range-bound market. So generally it just breaks a support, let's say, and continues on. And of course, MACD indicators. So in a basic strategy that you might want to create, or even an advanced strategy, you want to find as many solid reasons as possible, and then you give them maybe a points-based system, have that in front of you, potentially even laminated or potentially in an Excel spreadsheet or however you want to do it. And then you need to make sure that you have as many reasons as possible. So maybe set a rule: if I don't have at least 75 points to be in this scalp, then I will not place that scalp. And that's makes you accountable for each trade. You'll find that when you go over your trades over a month period and you say, well, why did I even take that? I can't remember why I took the scalper trade. And that's always what you see, because scalpers, we often take many trades a night. We might take 10 trades a night. People do that. Actually, it's about cutting out the bad trades will generally make you more successful. So to cut out the bad trades, make a system and be accountable to that system. Risk management, of course, you always hear the people say that 1% rule and don't risk over 1%. Yes, 1 to 2% of your account balance, you absolutely shouldn't be risking over that. It's ideal to stay with and within those kind of parameters. You don't want to basket trade either. If you see a good trade on the pound yen and the euro yen and the US dollar yen all to the short side, you may not want to take all of those because otherwise, if one doesn't work out, usually probably all of them won't work out. So try not to basket trade, and of course follow your built-in strategy. So just before we go back to that Australian dollar, let's talk about a couple of tips that I guess we've also learned over the years. So firstly, look at the larger time frames, even if you're trading a smaller time frame. We speak about it, we've talked about it a few times tonight. We used to be, scalping all the time. That's what we used to do all the time. And it is very time consuming, but it's important to understand that the big guys are on the daily time frames making very large decisions. When you're scalping, you're dealing with robots, you're dealing with algorithmic trading, you're dealing with other types of trades going on, and there's a lot of noise. So always look at the bigger time frames and then bring that bias or that trend down to the smaller time frames. You may not realize it now, but it will definitely help you a lot in the future. We want to also use the 80% rule when considering take profit zones. So if you're finding a support or a resistance zone that you think that could be where the take profit may need to be, then try to take it a little bit before that. So maybe about 80% of what you expect. And that will help you from, the trade almost getting there and then not quite getting it. Don't be too scalpely in terms of when you are scalping. We all want to get the perfect pip exit and say, check that out, and send that on the Instagram or on social media to your friends and say, look, I got it perfect. I'm the reader of the market. But ideally, if you want to be in the game long term and you want to be trading long term, take a little bit shorter. It's always great to do that. Consider gapping with your scalps as well. If you're scalping, you really probably don't want to be holding trades over weekends. This week, of course, is the Australian federal election. You would not necessarily want to be holding Australian dollar over the weekend because it could have some massive moves. And, potentially the close on the Saturday morning, our time, to the open on the Monday may be up to 50, 60, 70 pips. And that could be how much it gaps. We've seen that before, haven't we?
Yeah,
it can be bigger.
Absolutely. I've seen the euro gap 200 pips on a G20 summit. It can be very, very lethal. So you've got to be really, really careful in those situations.
And that brings us to the next thing. You may not know what's happening in another country, but look at economic calendars. So find an economic calendar that's good out there and look out for, generally it's marked as red news or important red news. If you're scalping, especially things like GDP, as Tyrone said, G20 summits, massive elections for the countries and that particular pair, try not to scalp around those sessions if you want to technically scalp, because the fundamentals can blow your trades out more than you initially had a stop loss for. And that's because the market moves so rapidly, it just goes through your stop loss and goes to the other side. So always check that out. And then of course we want to trade liquid pairs, and that's just really common sense. You actually want to be trading the biggest pairs because they're the ones that technically trade. They have a lot of big JP Morgan, Goldman Sachs, those kind of guys trade those pairs with algorithms and of course by hand. You don't want to necessarily be trading a very small cross pair because that won't be as technical. That will be more based on fundamentals. And we saw that a little bit with the Turkish currency and the big fundamentals that were at play there. And we've also seen it with a few other currencies over the last, a decade for sure. So always think liquid pairs, and liquid generally means big sized economies that have been trading for a long period of time. And of course, create your own business strategy. So we have ours in our course. It's the PRESIC strategy, which is based on price action, risk management, ELD, chart patterns, indicators, and charting techniques. And these are we like to use each one of these sections before we place any trade, whether it be a scalping trade or whether it be a 4-hour or daily swing trade. We always want to find as many reasons as possible to be in the trade. So a few guys said before, do you use Fibonacci? Absolutely we do. A few guys said, do we use pivots? We don't use them as much anymore, but there's no reason that you can't. They are definitely a good indicator, so there's no problem with pivots, but you want to find as many reasons as possible, don't you, Ty?
Yeah, absolutely. I've actually just sent a link to a short YouTube video that you can watch on the PRESIC system and how it works. So anybody who's interested can actually click on that YouTube video and take a look. It's a really interesting way to approach your trades, and we found it to be very, very successful.
Okay, so we'll just hand it over to questions while we go back to this Australian dollar. And do we have any questions out there just quickly? I know we've answered many of them, but if you have a question, we'll open the room for another 4 minutes or so to try to answer a few of those. So shoot, put them in the chat room now. Jump on over to these Aussie and pound. So we'll see the Aussie continues, I guess, to weaken with this candle closing bearish. There's another thing when you're looking at these trades. A lot of scalpers, we like to really look at each candle and see whether it's agreeing with us and making sure that it agrees with our trade. The most important things is that the story is consistent. So we have that short, we have the continuation, we've got the break of a new low, and then we've got actually not a bullish candle. We could have seen this potentially become bullish. So another bearish candle is really great. And for this candle, we'd love to see, of course, a break of a new low. People asking if they can get the links for our previous webinars. So actually just jump on YouTube and search Pepperstone. And if you do that, then you'll bring up Pepperstone's YouTube, and all of ours are there. They're usually under Learn It Live. And generally speaking, they're every 2 weeks. So you'll see them uploaded every 2 weeks. There's quite a few there. Quite a good library.
So for anybody, just in the meantime, while we're waiting for a few more questions, if anybody would like to join us on our webinar, we do an FX Evolution webinar, similar to tonight, where we analyze the live markets and look for trading opportunities. We run it at the same time tomorrow night. So I'll post a link to register in the chat window. So for anybody who's interested, who'd like to join us again tomorrow night, yeah, we do more learning opportunities, and we basically analyze and see what is happening in the live market. So feel free to click on the link and yeah, join us tomorrow night.
Anthony has a question about the US dollar index. Absolutely. Absolutely. We love the US dollar index. So generally with our analysis of the US dollar index, we do that again on the daily, weekly, and we look at the larger timeframes, but very important to look at the US dollar index, something we didn't do over a decade ago. Well over a decade ago when we first started, we didn't pay enough attention to the US dollar index, so you do want to do that. And if you see it break a very key support or resistance zone on the daily especially, you want to pay a lot of attention to that, and that will help you with your scalps. So yes, US dollar index, very important. If you're not familiar with it, guys, check out, just look up US dollar index and what it's made up of, and that will actually show you a lot of the major pairs as well. A few people asking about the major kind of candlestick patterns. Look, we love shooting stars and hammers, so you should definitely, a lot of people call them pin bars. You can, that's definitely a great candle. Also engulfing candles, very, very good. You don't want to overcomplicate it. So we know there's so many different patterns and so many different candlesticks out there, but think of the psychology behind a candlestick pattern. So think of actually what's happening and what the price action is telling you. And that will make a lot more sense to why some of the candlestick patterns that get very confusing don't make that much sense.
Yeah, we are actually in the process of doing a candle pattern cheat sheet, which is going to be available very, very shortly as well, actually. So for anybody who's going to the website and getting the chart pattern cheat sheet, the candle one will also be available shortly. So we'll send that out as well, because it is another really good idea.
Conrad asks the type of moving average we use, so 20, 50, 200. And EMAs and SMAs are both great. Obviously, EMA is faster, so maybe in scalping you might want that, but generally we use the SMAs. Divergence is good, Stephen, on all time frames, but specifically 15 minutes, it's fine. Divergence is great.
We find actually on 15 minutes it actually works quite well because the prices are moving so quickly really nice. That the divergence happens quite quickly. The moving averages are far quicker to react, so it's actually quite good. Definitely worth looking at.
And Mohammed has a question here. Do we wait for confirmation candle after shooting star to enter trade? Great question. No, we don't necessarily need to do that. So what you do want to do though, Mohammed, is that you would like to actually generally place a trade after it makes a new low. So what that means is, let's say this was actually a proper, beautiful shooting star that was maybe 10 pips in size. You would actually want to see it break by at least 1 to 2 pips, and then you would put maybe put a sell stop below, or just market order when it breaks through. And that allows you to see that the market is continuing in the direction that you want it to go. One thing you don't want to see, of course, is it closes like a shooting star, doesn't go even a pip below, and then all of a sudden goes through, breaks that. And that actually helps you with a lot of trades. It may look like you're giving up 1 or 2 pips, but it'll save you for those times where, I'm sure we've all had it, it goes backwards, and then it stops you out straight away, and you think, well, that was a terrible trade. Duncan says a trader he knows uses 8 and 21. That's fine as well. Like 8's good, and 21 and 20, they're very, very similar.
Yeah, they're very common. They're Fibonacci numbers. A lot of people use the 8, 13, and 21 because they're Fibonacci numbers. So yeah, they are very, very popular. But look, 20, 21, you're really not going to see a lot of difference there. So.
Great question. I kind of want to see this Aussie make a new low during the webinar.
But yes, I think it's done. It hasn't. I think, or just about has. Yeah.
Oh, it's about to do it. It's about to do it. Yes, John, we do use Bollingers. We like Bollingers. You won't notice that we use too many indicators, but we do like Bollingers. We just can't cover everything in one session. Obviously, tonight even, there's quite a few things going on.
Yeah, I think we need to do a few more 15-minute. Yeah, we're going to start doing a few more of these. Look, our webinars on Wednesday and Thursday nights, the FX Evolution ones are based primarily on price. So basically, we just talk about the live market. So yeah, you're going to get a lot of that action when you come to ours. But we're going to try and endeavor to do more Pepperstone ones where we actually analyze the live market as well, because people get really engaged in it, because there's nothing like seeing it happen at the time. It's so important. So yeah, we're definitely going to try and push for more of those.
And I kind of love seeing breaks of significant zones as well, because when you start to do a lot of trading and you've traded a lot on scalping timeframes, I'm sure, again, many of you guys will have seen it, even if you're just beginning in trading. When a key support or resistance is broken, the push through that zone can be very exciting, because it can move 10, 20, 30 pips very, very quickly because of all of the orders that were sitting below that zone. And that's the interesting thing and great part of price action, because when you see price action zones get broken, then you see that all that influx of orders getting hit and orders starting to get taken out. And yeah, it's very, very cool. All right, well, I think that will end us for tonight, and hopefully everybody has a successful week in their trades. And if you have any other questions, of course, I guess you could feel free to visit us tomorrow at our webinar as well.
Yeah, or email us at support@FX Evolution as well. Yeah, happy to answer any questions from tonight that yeah, you were interested in getting answered for you. Thank you for joining us. I hope you've all taken something out of it, and we look forward to seeing you next time.
Excellent, guys. And remember as well, ask your Pepperstone sales guys, if you don't have the advanced trading tools, see if you can get them from them, because it's awesome stuff in the MetaTrader 4 platform. Great. Thanks, everybody. See ya.
Thank you.